So welcome to the Council for the second session of today's Stephen C. Friedheim Symposium on Global Economics. We're taking an in-depth look at our 100-year-old central bank. And this second session is entitled Looking Back and Forward, the Federal Reserve. We've got a fantastic panel to talk about this. On my immediate left here is Liaquat Ahamed, who won a very well-deserved gold medal in the Council of Foreign Relations Arthur Ross Book Award for his book, Lords of Finance, The Bankers Who Broke the World, on the interwar central banking game, not just in the US, but elsewhere. I believe you may have won a few other prizes, like the Pulitzer Prize, but we start with the Arthur Ross Prize in this building. Then Willem Buiter, who is the Global Chief Economist at Citi, also now a visiting senior fellow here at CFR, and I think you were present at the creation of the newly reformed British Central Bank.
No,
the other one. The other Anglo-Saxon institution. After the Bank of England was sort of reconstituted, given independence in 1970, you were the first independent member of the Monetary Policy Committee and a prolific commentator on all matters macro. And then far on my left is Mark Gertler, who is the Henry and Lucy Moses Professor of Economics at New York University, a member of the Academic Advisory Board of the New York Fed, a co-editor, former co-editor of the American Economic Review, co-author of Ben Bernanke on about 12 or so papers, and one of the most cited people in monetary economics. So we're going to get started, and I'm going to go back to something that Stan Fischer said in a second. But I want to start with Liaquat and just sort of setting the scene a little bit. The Fed was created 100 years ago for reasons that were very different from what later became the central purpose of the modern Fed. It was really a reaction to the 1907 financial crisis. It was about being a lender of last resort. It was not about monetary policy because there was a gold standard, so you didn't need a central bank for that. So it was really a different kind of central bank. Can you paint the context, what people were thinking in the United States when they created the Fed?
Sure. I mean, the US did have a central bank in the early 19th century. And because there was grave doubts about centralizing so much power in a financial institution, the Bank of the United States was closed down in the 1830s. So for 70 years, the US did not have a central bank. Meanwhile, all the European countries did have central banks. So there was the Bank of England, and which was the predominant central bank in the world. And the Bank of England took on the role as lender of last resort to the financial system gradually. So it was actually quite reluctant to become the lender of last resort. In the 1860s, it famously led in a sort of Lehman-type event, it let a British financial institution over in Gurney go under. And from that period on, it acted as lender of last resort, and Britain did not have a financial crisis for the last 40, 50 years, or did not have bank runs for the last 40, 50 years of the 19th century. And while the US had 5. So it was the Fed was created essentially to act as lender of last resort after a financial crisis.
And Willem, I mean, part of the interesting turnaround we've had in the past century is that at the founding, when the Fed was set up to perform this lender of last resort function, it was assumed that this could be done without creating moral hazard. I mean, Bagehot's dictum was, so long as the central bank provides lending against strong collateral and at a penal interest rate, there won't be moral hazard, it's fine. There is huge moral hazard, meanwhile, if we have the central bank printing money. So therefore, we need gold. So in other words, the thinking today is basically the inverse of what it was 100 years ago. Today, we worry about moral hazard around the lender of last resort, bailout stuff. But we basically view that fiat currency can be done without moral hazard. In the founding, it was the other way around. Does that sound right to you? And is it inevitable that this shift then ensued in the next century?
No, I think the moral hazard associated with both dimensions of the central bank stars. And of course, under the gold standard, you can't really do much about anything. You can't be an effective lender of last resort because since you can't print gold, if the market decides to challenge you, they can always strip you of whatever gold reserves you have, so you're vulnerable. Everybody on the gold standard, in principle, is Iceland. I think the Bank of England was very lucky that they got away with it for as long as they did. I don't know how they managed that, but probably there was no conflict between what they wanted to do in terms of interest rates for monetary policy reasons and what they wanted to do for financial stability reasons.
Can I just interject?
Yeah.
They basically used to suspend the gold standard in
It's
the financial
yeah.
crisis and would get a letter of indemnity from the government saying, we indemnify you and you can follow whatever rules are necessary and you don't have to obey the gold standard rules.
Yeah, that certainly is a solution. But yes, I think that even today, moral hazard is, especially I think in the field of financial regulation supervision, is too little recognized, especially when it's reinforced in the field of regulation supervision by regulatory capture of the institutions that are meant to be preventing the moral hazard. So the combination of inherent moral hazard and regulatory capture makes for great vulnerability and fragility of the financial system. And that's not gone away. We haven't really addressed that yet.
So, Mark, I mean, so Willem is confirming that today we worry a lot about moral hazard with respect to the financial supervision and the lender of last resort stuff. I don't think that was so much there at the founding. But let's talk about the obverse for a second. So on the interest rate setting and monetary policy side, this is a fantastic story of successful public policy, right? You start with the gold standard. You think we couldn't possibly do discretionary monetary policy without it being a disaster. And now we, in fact, do have it with an flexible inflation targeting regime, which most people accept. Is that right? Was this foreordained? Were there crucial tipping points?
No, I think the Fed has learned through experience. And when you say successful, I would say mostly successful. There's been three pivotal periods in the history of the Fed, each associated with an economic disaster. The first was the Great Depression. What did we learn? We learned that the Fed shouldn't stand by the gold standard as it was forced to do during the Great Depression. In fact, the evidence is very clear that the countries that stuck with the gold standard experienced the worst depression. So the lesson is, when a crisis like that hits, you want central banks to intervene as quickly as possible. The second disaster was the great inflation of the late 60s and 70s. And there we learned that the Fed had to step in to contain inflation. We also learned that the job of the Fed is a lot easier if there's a clear nominal anchor, and hence the birth of inflation targeting. And I would say the third pivotal moment was very recent, the Great Recession. There we learned that even though financial markets have become a lot more sophisticated, that doesn't mean they become more stable. And that means that we have to be vigilant when it comes to regulatory policy. We've got to do a much better job of staying ahead of the game than we did in the past.
Liake, we still hear people in the political debate sometimes advocating a return to gold. And if Rand Paul makes a run in the primaries, perhaps we'll hear some more about it. You do quite a good job, as I remember in your book, of explaining this sort of almost, I don't know what, emotional allure of gold. I mean, why do you think people always go back to it?
Well, I think it's rules versus discretion. So, and the problem with the gold standard is that if the global economy is growing at 4%, that means the financial system is probably growing at 6%, and gold supplies only grow at 2%. So there's just going to be a progressive shortage of gold unless you allow gold prices to go up steadily at 4% a year. So I think that's the fundamental flaw of the gold standard. Can I come back to the picture you portrayed of a steady improvement in the conduct of monetary policy? And I want to go back to something Stan said, which is we actually unlearned some lessons. There was a period in the 1950s and 60s under William McChesney Martin where the Fed actually did a fantastic job of having low inflation and high growth by essentially following a sort of implicit inflation target. That every time inflation started going up, McChesney Martin, who was the one who invented the phrase, take away the punch bowl when the party gets going, would start tightening. And we actually got a period of stable inflation. And so I think the interesting question was, why did we unlearn that lesson in the late 60s? Was it because of the Vietnam War and the pressures, the political pressures? Was it a sort of failed Keynesian attempt to exploit a Phillips curve that didn't exist? So we've actually come back full circle, back to the 50s.
Mark, in the mid-90s, I think, you had a paper which was entitled Inside the Black Box. And what you were talking about is the way that the monetary transmission mechanism, you move policy rates, the Fed moves policy rates, and then it goes through some black box, and then it affects the real economy out there. You described it as a black box because it was hard to figure out how this thing worked. Of course, I'm sure that your research has shed enormous light, and now it's just a grey box. But I think it would be no disrespect to you to say still precisely how long rates will react to short rates is something the Fed can have a view on, but doesn't know for sure before it moves. And so we have this paradox, right, where monetary policy has stabilized prices remarkably well, and yet the mechanism used to achieve that is understood remarkably little. I exaggerate a bit for effect, but isn't there some truth in that?
Yeah, I mean, over time, I think central bankers have learned to be humble, and I think that's actually made them more effective in the way that they go about business. I think we've learned throughout time, and this idea goes back to Milton Friedman, that we just don't know enough to fine-tune the economy. But that doesn't mean to say the Fed should stand on the sidelines. It can still do something very useful. And I think the mentality of the modern central bank is to avoid disasters. That is, we haven't, even though we don't understand the precise details qualitatively or quantitatively, we have a general sense of the direction of monetary policy, the way it works, how it affects the economy, and we can use that knowledge to contain disasters, like contain the double-digit inflation of the 70s, moderate how bad a recession could be. So I think the Fed is still very successful at that, so long as it keeps its goals modest.
So Willem, as I understand Mark, he's saying, even if you don't precisely know what the heck you're doing, you can still improve the world because you understand enough about it.
Well, I make or it actually goes to Robert Lucas, you make the analogy between driving a car along the road. I mean, you start to tilt off a little bit, you know which way to turn the steering wheel. You don't know exactly, you can't calculate exactly.
But the steering wheel only turns one way now. Right? They're at the zero lower bound.
Yeah.
So all these sophisticated central bankers manage to get themselves in a situation where they can only turn left. So that's not very good.
Well, no.
Did you choose left as opposed to right on purpose?
But again, I think, okay, the problem is we're always good at solving problems in the past. I think we figured out how to solve the problems of the 60s and 70s, a double-digit inflation. In fact, from 84 to 2007, did a remarkably good job. Where we missed out is we did not see the financial vulnerability that hit the system. And now we're kind of trying to learn how to deal with that.
I mean, so there is one view, which is that the way you reconcile this apparent paradox of success in the outcome with respect to inflation, but lack of clarity on how on earth that worked, is that to say, look, there were other things going on in the world. Globalization was driving down prices. Technological change was driving down prices. Productivity innovation stemming from deregulation in the 1980s drove down prices. And so to some extent, central banks got lucky in the period from, let's say, the early 90s to the crisis, and delivered price stability because of stuff that was going on in the real economy. Is that?
I think you can't dismiss an element of luck, but I think the knowledge involved in monetary policy making has increased dramatically over the years. If you compare the 90s and 2000s compared to the way we're just mucking around in the 60s and 70s, like the growth of the idea of inflation targeting, the use of Taylor rules to guide policy. I mean, look, we're not omniscient, we don't know everything, but I do think we have something to offer about the way we should conduct monetary policy. Just the problem is, as we go through time, we get hit with new crises, and that's the challenge, being hit with stuff that's new.
Liaquat, Willem, you want to comment on the lucky man theory of central bank supremacy?
Well, I don't think they've been very lucky. They find themselves in a position where inflation systematically undershoots whatever target they set themselves. In the euro area, it's spectacular. Here it's persistent, not spectacular. And the ability, I think, to respond aggressively should there be a major failure in effective demand, either externally or more likely from a loss of animal spirits in the household sector, or is very limited. No, I think central banks have much to be modest about.
So I'm going to take the other view, which is that rather than the lucky theory of inflation, the great man theory of inflation, which is that I don't think you're giving enough emphasis to how important Volcker putting the US economy through the ringer was. I don't think you're putting enough emphasis on the fact that in '84, when we had started recovering, Volcker raised real interest rates to 6%, and sort of cut off an incipient inflation. I think Greenspan at several points acted preemptively. And if we'd had a different person in that job, we might have had a different outcome. And I think that's throughout the history of central banks, that who is the chairman of the Fed is incredibly important.
Go on.
I don't think we can absolve fiscal policy from this discussion. I think fiscal policy has made the life of central banks much more difficult. The debt ceiling fights in the US, the chaos in the euro area. And so the Fed is sort of left as the only institution kind of dealing with the problem of stabilization.
I agree with that, but that also created a real crisis of legitimacy, right? The Fed, like the Bank of England, like the ECB, were forced to take on quasi-fiscal roles that are probably illegal, certainly against the spirit of what the law meant in terms of fiscal actions required the consent of the Congress or Parliament or whatever. And it was simply because of a manifest political failure that the choice was we either have an economic disaster that makes the Great Depression look like the teddy bear's picnic, or we're going to do things that we should not be doing because this is not our, we weren't created for this. So it was, I agree, it's an impossible situation to be in. But so institutional reform is really what's required to cure this mess, because we still haven't changed it. Washington is still paralyzed.
I'd like to switch the discussion. So Stan's made this point that notwithstanding Willem's robust remarks, we have learned quite a lot about conducting monetary policy with respect to interest rates. Flexible inflation targeting is a regime that people feel comfortable with, and it looks like it might be a lasting one. Now, so if we leave that aside, we talk about the other challenge that central banks face, which he viewed as something very much more of a work in progress, namely, how do you achieve financial stability? Maybe again, we can go back to the pre-war period with Liaquet to begin with, to set the stage. As we began by saying, it was thought initially that achieving kind of lender of last resort bailouts on Bagehot's principle could be done fairly straightforwardly, and yet it proved to be a disaster. Can you recreate that period in the 20s and 30s? Why did it go so badly wrong?
Well, first of all, on financial stability, I'd separate two issues. One is preventive. How do you prevent a financial crisis? And secondly, what do you do in a financial crisis? So on the second, what do you do in a financial crisis? They did basically everything wrong in 1929. They only lent to members of the Federal Reserve System, which accounted for 1/3 of the banks. So 2/3 of the banks had no financial lender of last resort. They would only lend under very restricted collateral. And the Fed learned the lesson this time. They lent to everyone, and they lent against almost every type of collateral. So I think we know they did the wrong thing then. We prevented a financial crisis this time, and it's not clear to me whether they went overboard and whether they, in the effort to prevent a Great Depression, we created a whole series of other problems. On preventing financial instability, frankly, I don't think we have a clue. I mean, we have the Basel capital rules, which say that the financial system is stable as long as people have 3%, a 33 to 1 leverage ratio. And we have other people who say that the maximum you should have is 5 to 1, that you need 20% capital requirements. So somewhere between 3% and 20% is the answer, but we don't know where. So I'm afraid I really don't think we know enough about what are the requirements for a stable financial system.
So just to clarify, does that mean that, in fact, when Bagehot in the 19th century enunciated his principles, they might have been right for the 19th century, but by the 1929 and 30s, they were actually a problem because they constrained the central bank's activity too much?
I mean, I think when Bagehot enunciated his rules, the typical bank had 20% capital. So, and so he was primarily focused on liquidity crises. There were very few occasions when the whole system was insolvent, which was what happened in the Great Depression. So I think the Bagehot rules were for a liquidity crisis with a large capital cushions. We're not in that situation anymore. We have small capital cushions, a financial system that is relative to GDP 10 times the size. So I think we're dealing with a completely different animal.
But maybe you've given us the solution, right? If 20% cushion did the job, then maybe we should go back to 20% cushion and apply it not just to banks, formal banks, but to anything that passes the duck test for being a bank. Right? So anything highly leveraged with mismatch in duration and liquidity between assets and liabilities, that's a bank. And so the only reason not to do that is the interest deductibility versus dividend non-deductibility. That's also easily solved in principle. It just and interest deductibility.
Try persuading the bankers in the room.
Yeah.
Well, Arminio Fraga.
But if that's the solution, I mean, if
Well,
I was just making one more. So in Brazil, I was just hearing from Arminio Fraga, who'll be up in a minute. They address this issue partly by imputing an interest to the equity side of the bank's funding, so that the advantage of debt is reduced. So there are countries that are grappling with this. I'm sorry, Mark. Go
abolishing the corporate income tax would also help.
But my understanding, the problem this time was not so much with the initial capital ratios in the commercial banking system, but the problem outside the Fed's direct regulatory control in the shadow banking system. So it seems to me the challenge is to kind of extend the safety net and regulation to all systemically relevant institutions.
I think as a description of the crisis, it's completely wrong. All the large Wall Street banks were woefully undercapitalized.
Well, but the
tiny capital ratios. I mean, barely visible with the naked eye.
But the exposure was from the initial exposure was from the investment banks. It is true once the crisis hit in the investment banking sector, the commercial banks did not have enough capital to absorb the assets of the investment banks. But the initial fragility was in the shadow banking sector.
Washington Mutual?
Well,
let me just push the story chronologically on. So Liaquat has addressed the interwar period. In response to that, you get deposit insurance and you get a new round of regulation, extending the safety net. And then in the post-war period, until sometime in the 70s, perhaps starting with Penn Central's crisis in 1970, you have this famously stable period in finance. So people look back to that and they say, well, gee, that shows that a lot of regulation is a good thing, and that really did stabilize the system. As you and I have discussed, I wonder what is the regulation that was removed after 1970 that then destabilized things? Can you help us with that?
Well, I think there were two factors. One is easing on the restrictions on the types of assets that banks could hold. I believe in the crises in the mid and late 80s, a lot of banks got into trouble with risky commercial real estate lending. The other factor was the growth of the managed liabilities markets, the large CDs, money market funds, and so on. And this led to the increased risk exposure of banks. So we had a more fragile system than we did sort of at the height of regulatory tightness in the 60s and 70s.
Liaquat, could you imagine a different history where we had foregone after the 60s, foregone some financial deepening and not allowed the financial sector, as it were, to do the things that Mark is describing. If you prevented or capped commercial bank exposures to real estate, would there have been things that might have given up a bit of growth in the short term but brought more stability?
Yeah, I mean, I have to say, I think it would have been better to have focused on the liability side. So the way banks finance themselves rather than, banks have always done risky things on the asset side. But I think the big change was banks went to wholesale funding, the repo market became gigantic, investment banks, I don't know, Lehman was borrowing $200-300 billion every day in the repo market, and I think that was the fundamental source of the instability, wasn't it?
No, I still think it's too little capital. I mean, financial instability of solvent institutions can always arise when there's a mismatch between in duration between asset and liabilities and liquidity. But that's the nature of banking. That's what intermediation is about. So you want to have that, and that's what we have lenders of last resort for. Right? The fact that Lehman didn't have a lender of last resort because it wasn't part, it couldn't go to the Fed, was a real problem. The combination of much higher capital requirements and a lender of last resort that deals with any entity that needs it is a principle they can. I mean, if you look at it's as private individuals that can just about go discount at the Fed, right? I mean, individuals, partnerships. I don't know whether it's individuals.
So why is it, that if that's the answer, why is it that much higher capital ratios are not being demanded from the financial system?
I don't know. And why do they impose higher liquidity requirements when liquidity is a public good? Capital is the private good. That should be provided by the bank.
Well, banks don't like higher capital requirements because raising equity is expensive. But the conundrum is they know they're going to be protected in a financial crisis, and that's going to even increase the incentive to have lower capital.
Raising equity is only expensive.
But let me say one other thing. I think it's, again, look at the current crisis. The Fed didn't know what's going on. It couldn't see most of the vulnerabilities because most of it was happening outside the commercial banking sector. And the pivotal moment in the crisis, as I look at it, was the day when Lehman was going under and the Fed didn't know about AIG, did not know the risk exposure of AIG. And I don't think we want to find ourselves, if nothing else, we can all agree we'd like transparency. So the Fed, we can disagree on what the exact capital ratio should be. But I think we can all agree we'd like the Fed should know what the risk exposure of the system is.
But there was fundamental ignorance, not just of the facts, but of how the economy worked. In May or June 2007, I think it was, Ben Bernanke said that basically on balance, subprime mortgages are a good idea. Right? One or two problems with it.
Yeah,
so they had absolutely no idea what was happening. The belief in self-regulation, right, which is a contradiction in terms, was inherited from Greenspan to Bernanke. Right? The self-regulation stands to regulation.
I take that as part of the point is the Fed didn't understand the vulnerability of the system. No one understood or saw the chain reaction that would happen once you had a series of
it's not mainly not transparency, it's a lack of fundamental understanding of how the economy actually works.
If we go back to your papers in the 80s and 90s on financial fragility, because I think you wrote several, I mean, did you foresee that financial fragility could have this higher price to grow?
This is our goal, our motive for that particular research was to try and understand the Great Depression and the emerging market crisis. We did not foresee the current crisis, but what we learned was in a downturn, if credit markets are disrupted significantly, that's going to create an ordinary downturn into a severe recession or a depression, and it was incumbent upon policymakers to react quickly in a situation like that. I don't think anyone I know, where few people foresaw the current crisis because they didn't see the vulnerabilities.
But there is a paper which I don't think you were a co-author on, but Ben Bernanke did a paper about the 1987 crash. And he wrote it a couple of years afterwards, and he looked at the futures broking system and the options market makers in Chicago who almost failed. And he observed that because the New York Fed was able to call up the banks in New York that were financing the options market makers and tell them to keep on lending,
Yeah.
that the system as a whole ended up being very stable because you define the system to include the central bank, which can twist the arm of the commercial banks, which can put liquidity in when you need it. So it seems to me, and correct me if I'm wrong, but there was a view that ultimately crises can be nasty, but with a good central bank that understands the precedents of the 1930s.
This was the perverse effect, Willem and I were talking about before, the Great Moderation, the period of stability in 1984 to 2007. The economy was doing so well that we thought we'd solved all the problems and there was nothing a central banker couldn't do. And that proved to be incorrect thinking.
So let's take one more historical crack at this question of financial stability. I mean, you could argue, perhaps, Liaquat, that right now, when people say macroprudential tools, there are those who would say, and I think Bob Rubin and Marty Feldstein wrote an op-ed in the Wall Street Journal about this, there are those who would say, macroprudential tools, well, what does that actually mean? Can you please list these tools? Central banks don't appear to do that. And so there's a kind of empty toolkit suspicion about these tools. But perhaps if we were to look back at the course of the use of monetary policy for purposes of inflation, you begin with tools that people don't think can work. You try them out a bit in the 70s and lo and behold they don't work. But after that you do get them right. Do you feel the same, that one can make a same sort of optimistic take on financial stability for the same reason?
You know, I think the inflation tools, which is raise interest rates somewhat preemptively when inflation is just beginning to emerge. So the question you ask, is there an analogy there in financial macroprudential? So can you imagine at the moment some central banker saying, God, you know, there's all this speculation in the high yield market, and we should impose some drastic margin requirements on high yield bonds. Now that's the sort of thing it takes. And I don't see the political, I don't see the political system allowing central banks to act preemptively, because the system has the sort of stability of a bicycle, not the stability of a table. And you know, when it's going forward, it all seems fine, that everyone's lending to all sorts of people at the moment. But there are other people saying that the high yield market is in a big bubble. I don't know the answer, but I don't quite imagine the Federal Reserve Board getting around and saying, okay, we need to do something about the high yield market.
Willem, could you imagine your former colleagues on the Monetary Policy Committee of the Bank of England sitting around the table and deciding to order British banks out of high yield?
No, but I can imagine the FPC doing that. They're doing it, right? They have been given at least a number of tools. The markets that really matter are those fundamentally for the outside assets, ignoring net foreign assets because America is a closed economy, as everybody knows. You know, it's basically real estate, land, and equity, right? And they're provided, you either have a variable land tax, which would be a fiscal instrument, or the kind of stuff that the FPC has, the Financial Policy Committee, which is variable loan-to-value ratios, variable loan-to-income ratios, and also the ability to move the capital ratios, the Basel capital ratios in a counter-cyclical way. And provided then you also have some margin requirements to think around this equity if you think that's, that should be a good start. You may want to invent others. But they will use them.
Isn't Liaquat
They will use them. In Sweden, right, they are using the macroprudential instruments very aggressively. It may not be sufficient to prevent an implosion of the housing credit market, because I think the house is sitting on 200% of GDP worth of the disposable income, I should say, worth of debt. It's an impressive number. But yes, I think that would certainly go a long way. And you have to adapt the toolkit as new financial innovations occur. It's always chasing a moving target, but at least as long as you keep running after it, you don't get too far behind.
What do you think, Mark? So let me just sort of put the question this way. We've had a disagreement here, which is always nice and fun. You know, so imagine that the government in whichever country, in the form of the central bank, comes to the financial sector and says, we determine that you guys are overexposed to commercial real estate, and you should pull back, not such high loan-to-value ratios and so forth. Won't the financial sector turn around and say, well, A, I know more about commercial real estate than you do, Mr. Government, and B, if you pull me out of it, there's 5 other guys, some of whom are foreign, who are going to come here and finance it anyway, so you won't achieve anything.
I think realistically, the best we can hope for is to get the long-run regulatory structure correct. That is, have capital ratios right, make them broad and relevant to all systemically relevant institutions. Doing counter-cyclical policy, I see, is very tough because it's very hard to identify clearly what you want to go after. You see a growth in housing prices, you know, is that a bubble? Is it appropriate? It's hard to say. Now, the other thing besides long-run regulatory is to be doing stress tests so we can get a sense of what the risk exposure is, and so the central bank can be prepared. But it's sort of fine-tuning the way we do adjusting the funds rate. I think we're a ways off from being able to do that.
Well, so just, all right. So
Stress tests have been a joke, right? I mean, in the euro area, even the central bankers themselves are now saying that they once again missed the target.
but Willem, will it always be a joke? I mean, don't these things always start with attempts that get criticized, and then because of that criticism, they get improved?
No,
Isn't that how public policy
I
gets
think
better?
you simply force institutions to hold enough capital so that if they do something silly, they can have a question to absorb it, rather than try to micromanage them. I think that is. We read the Basel regulations. It looks like the U.S. income tax code, right? It's completely incomprehensible, so that will not stabilize anything.
But the complexity is that to determine whether or not they have enough capital, we have to do something like a stress test. So we got to figure out how to do it better.
Think of a number and double it. Really.
I want to ask Mark one question before we go to your questions, which is the following. You've just said that realistically, you need to get financial regulation right in a static way, and trying to fine-tune it because of where you are in the economic cycle is too ambitious. Does that therefore mean, since we do have cycles, and cycles are bound up with finance, that it would be fair to use interest rates to dampen these credit cycles, accepting some more variability in inflation as a result?
Yeah, I think the problem with using interest rates is we have more targets than tools, at least we used to. In other words, we care about unemployment, inflation, and financial stability, and you want to put that all on the interest rate. And let's go back to the period 2001, 2004. Everybody said the Fed should have raised interest rates over that period, but what they forget was the unemployment picture was very bleak. And had they raised interest rates enough to curtail the housing bubble at the time, they probably would have made the unemployment situation much worse. And we've had another recent example about that. The Reichsbank followed this logic. They raised interest rates because they were concerned about financial pressures. That further weakened the economy, and they had to reverse course. Now, one possibility might be to come up with more tools. For example, the Fed has a mortgage portfolio now. Maybe if the housing market they feel it's overheating, they have some reason to believe, they could start selling mortgages. But using the funds rate to target asset bubbles, I don't think that's a good idea.
But just, you know, if you had to choose between avoiding financial instability or avoiding price stability, in other words, stable inflation, which really matters more? I mean, inflation that varies between 2% and 5%, is that a big deal?
They're not completely unrelated. I think one reason the crisis was not even worse than it was is the Fed was able to maintain its inflation target, or keep inflation within target, as opposed to have a big deflation. But I think, you know, these are not easy problems, but I think the best bet, if we had proper regulation, we wouldn't have found ourselves in the mess we did. If we didn't allow subprime lending to be to go on, we didn't reduce lending standards, we didn't allow these loans to be securitized, we wouldn't have found ourselves in the mess we did. And it seems like you don't want use monetary policy to undo the mistakes of regulatory policy.
Okay, well, let's go to questions from the members. If anyone's got a question, please raise your hand. I can see right over there, Jeff Franco. Microphone coming up.
Jeff Schaefer. There was a lot of discussion about bank capital, and banks think it's too expensive. A lot of professors out there who think it's free.
No, it's just,
Yeah,
just
it's no
just
more
as
expensive than raising funds
except for
otherwise.
the silly tax. Yeah.
I wanted to get your sense of how much more would it raise the cost of intermediation if through banks if you went to Willem's 20%?
Well, if you have the interest deductibility, then it would raise it by some. Yeah. No, I think it would have negligible effect.
Anyone want to debate that? You could raise capital requirements to 20% higher and it would not affect the cost of capital in the economy?
No, because it lowers the cost of debt financing.
Yeah,
of
no,
course.
I understand the argument. I'm wondering if anyone wants to debate it. Do we have a
I don't.
consensus?
I don't think we know for sure.
Yeah, but we also it's worth trying. Since the alternative hasn't worked.
Yeah.
Sounds as if we should go to 10 at least for a start.
Well, if you're Larry Kotnikov, you go for 100%, right? Pure pass-through. Or limited liability if you want to do anything else.
Yeah, one can argue, though, that there is a subsidy to debt finance, partly the
Yes.
tax deductibility and also the implicit lender of last resort protection. So,
Yes, but that can be addressed by,
By capital
also and by better bail-in arrangements, right? So that so the last unsecured debtor is bailed in before the taxpayer walks up to pay. I think that has to be the norm. You should be able to restructure any corporate at the speed of light if necessary, and if you can't, then it shouldn't exist.
Another question, yes, John.
John Macon, American Enterprise Institute and Cornwall Capital, very stimulating panel. And I think I sense the feeling of humility that the crisis has brought to many of us. But I'm troubled a little bit by one thing that Mark said, and that is that nobody foresaw the crisis coming. I think a reading of the memos going around most hedge funds in 2007 that the Fed didn't show much interest in would disprove that. Counterparty risk was alive and well, and it was quite clear by the end of 2007 that what was going to happen if Bayer wasn't enough of a warning, what was going to happen with Lehman was definitely there. So the Fed did a great job. They prevented a financial meltdown, but I would like to see a little more effort to communicate with people in the financial market, and maybe a little more humility about we didn't foresee it, so there's nothing we can do about it.
Anybody want to respond to
I
that?
don't think that's right at all. I think that
It is
yes,
right.
A lot of,
I'll
no,
show you the
a lot
memo.
of people foresaw some, financial kerfuffle, right? People foresaw the subprime crisis. Quite a few people did.
I don't think
People
if you
saw
said a
the
financial
counterpart
kerfuffle,
problem.
it would have.
But I'm talking now before 2008, right? Nobody foresaw the size, cataclysmic, North Atlantic financial crisis that materialized.
I'll show you some written material that does.
Well, I mean, maybe the answer here is exactly what Liak had said earlier. In other words, it's one thing if you're at a hedge fund to be able to see that there's a 60%, 80% probability of something big and to adjust your positions. You don't have to be sure you're right. If you are the Fed and you're going to go and tell private...
capital is at stake. Actually, you do have to be right.
No, because probabilistically in trading, you can decide that the best call for your own capital is to take risk off because you're worried. And you don't have to be accountable to anybody apart from your own investors. If you are at the Fed, the central bank, and you're going to go tell other private institutions to get out of certain positions, there's a much higher standard, I think, in the public square required of and that's Liaquet's point, is that one of the problems with hoping that a central bank can pull financiers out of risky trades before the next crisis is rendered improbable by the fact that the standard of certainty that the government needs to have to do that exceeds the standard of certainty in a private investment house.
And also, I'm not sure if they had decided we were going to get a major financial crisis in 2007, was it too late? I mean, the size of the financial system was gigantic by then. The undercapitalization was enormous. The liquidity mismatch between their liabilities and their assets was gigantic. I'm not sure there was anything they could have done.
And the fact
at
that the
point.
investment banks had no lender of last resort, right?
Yeah.
Which was
So
Well,
you
got
couldn't
one.
stop the bicycle without falling off the table or something.
Yeah.
Yeah, let me be clear. There were
Mixed
people. There were people who saw that there were potential vulnerabilities in the system, and certainly we have to give a lot of credit to Ned Gramlich, who first warned about the subprime crisis. What I had in mind was that nobody saw how everything fit together, just partly because it was so large and partly because it was so hidden, and nobody saw how the transmission mechanism would play out. There were people like my colleague Nouriel who warned against that housing prices could collapse and this could create a crisis. But if you go back and look at the crisis that he described play out, it was quite different than the one that actually did play out. And also the other point is, I don't think the Fed uses this as an excuse to, I think they feel bad about it.
And in the
trick is to avoid the
initial few months, the Europeans were congratulating themselves on having weathered the storm, and no one foresaw the sudden stop in capital to all of the peripheral countries, which then occurred. So there was a sort of second dimension.
the
to the crisis.
2010.
Yeah.
Well, yeah. And they're not foreseeing the 2015 crisis either.
Another question. Matthew Klein.
Thank you. Financial Times. I'm wondering, it seems to me that the way the Fed and other central banks work, adjust their targets and adjust their metrics for hitting inflation depends a lot on forecasts about what the real economy is going to do and how their interest rate policies affect the real economy and how that flows through inflation. How is it that they've at least apparently managed to be very successful or relatively successful in that, and yet don't think that they can have the same level of confidence in forecasts about asset prices, leverage, and other activities in the financial system, and the way their tools, which affect the financial system more directly than they would the real economy, in any case, how that works? It seems to me that there's a disconnect between the confidence, relatively speaking, that they can make projections about the real economy and inflation, and the humility about the extent to which the Fed and other central banks can affect financial markets and financial stability.
Well, I think, first of all, that's a great question. Now, the Fed actually has a comparative advantage in forecasting the macroeconomy, inflation, output. They have good data. They have a great staff. Go to the private sector, they lose that comparative advantage. All these brilliant financial economists pricing assets, and it's not clear that that the Fed is certainly not better than it. The question is how much worse they are. So that's one consideration. The other is financial markets are much more volatile objects. There's lots of stuff that goes on that we just don't completely understand. There's behavioral issues, market psychology. Output and inflation are pretty slow-moving relative to what goes on in financial markets. So the short answer is, it seems that the private sector is better at pricing assets than the Fed is, and the Fed's better at understanding the macroeconomy than the private sector is.
I mean, I would add a second one, or third one, which is there's sort of a discontinuity in finance, which doesn't seem to occur when you're just tracking inflation and the economy. That there are sort of smooth curves and you can respond, whereas when leverage gets to, nothing happens as leverage goes up to a certain level, and then suddenly, everything happens. And sort of those sorts of tipping points are much harder to forecast.
That would be an argument then for for instance, using interest rates for financial stability purposes by raising them when leverage, either in the non-financial private sector or in the banking sector, whatever, it's too high. And that, in fact, I'm in favor of that. I think the Fed's notion that, well, the Fed version of a macroprudential policy, which is very much like what Mark described here, which Janet calls across the cycle, right? That basically means structural strength, right? Just ability to resist shocks, so that crises are A, less likely, and B, if they happen, do less damage. I'm all in favor of that, but I think even then, I think leaning against the wind of rapidly rising leverage or rapidly rising asset prices is, I think, desirable and necessary, partly because it is simply implied by regular inflation targeting. The reason that I think that the Fed believes there is a conflict is that the Fed is inflation targeting over 2 to 3 year horizon. If you let a financial bubble run, I think we're not going to lean against this. You're inevitably going to have a crash and a period of undershooting, maybe years from now. But I think if you take inflation targeting a long-run perspective, the financial stability is simply a precondition for price stability.
But so you think the leaning against the wind should take place with interest rates as well as leverage requirements, or?
Everything you can have, because as Jeremy Stein pointed out, basically macroprudential is regulatory. Ergo can be arbitraged, will be arbitraged. The only thing you can't get away from is interest rates. They go into every pore, so to speak. And so, yes, you definitely need interest rate, the interest rate instrument in addition to the macroprudential. I wouldn't use them both, right? But I think the Fed is far too reluctant to use interest rates for what I would call macroprudential reasons.
Mark?
But the challenge is a situation like the current one where the economy still hasn't completely recovered and inflation is running under target. So
life is difficult, so
well,
that's what you get paid for.
But the Riksbank just tried that and it didn't work so well.
No, that's right. And then you try again. I mean, you have to learn, right? There's no reason for saying we shouldn't do it. Yes, life is a mess, and central banking is very, very difficult.
But
I mean, fundamentally, Mark, isn't it a question about which are you more scared by? Are you more scared by the fact that it's inflation below target?
That's a good
Or
one.
are you more scared by the fact that asset prices may be bubbly?
At the
Which can
moment-
do us more
sure,
damage?
That's right. What I'm more scared about is a lost decade, another lost decade like Japan. You look at, even though the labor market is showing signs of improvement, we are still way below the old trend that we started out on before the Great Recession. The employment to population ratio has not recovered. It's recovered maybe a quarter of where it was before. So right now, I think you put it well. It's what you're more scared of. And right now, I'm more scared of.
And what you believe you can do anything about. I mean, the notion that the Fed has a serious handle on the long-term ratio of employment to population, it's possible, but it's by no means obvious, right? You have to really believe in
the fact
hysteresis.
inflation is running below target tells me that there's still weakness in the economy.
Let's have a question on the aisle there, Ben.
Also on foreign relations. Throughout my adult life, there's always been some dominant theory in central banking indicating that the central bank operating wholly on its own could stabilize the economy. This theory today appears to be market monetarism, the idea that the central bank should do what it takes, potentially, for example, limitless asset purchases to keep nominal GDP growing at a rate of, say, 4 to 5%. I'd be particularly interested in Mark and Willem's thoughts about this, the growing popularity of this idea.
No, only if the central bank can engage in helicopter money, but overtly fiscal measure, would that be the case? Yes.
Yeah.
And if they can also reverse it, in other words, take it out, hoover it up, right? So that, yeah, but otherwise, no. You need fiscal for it to be effective.
Yeah, and it's,
A combination.
that's right. I mean, what the Fed can do is contain damage. which I think it did in the last recession. But you need the cooperation of the fiscal policy. Right now, the Fed is fighting the fiscal authority.
Right in the middle there.
Hi, Andrew Hussar, Rutgers Business School, formerly Fed, formerly Wall Street. There was some celebration of Paul Volcker early in the panel, it's his heroic raising of interest rates back in the 80s and 70s. And if you look at the Fed today, compared to then, I'd argue the challenge facing Chair Yellen is much greater. The Fed's balance sheet is now 5.5 times the size it was in 2008. It used to operate only on the short end of the curve. Now it owns basically 30% of U.S. government debt from a duration perspective, 10% of the housing market. The Fed used to release interest rate decisions weeks after meetings. Now we have press conferences on FOMC days. So my question is for the panel, do you think that what Paul Volcker did is even possible in today's Fed? Obviously we have 2015, we have this discussion of even a small rise in interest rates, which is eliciting huge nervousness in the financial markets. Can the Fed get back to where it was, or are we living in a new world?
Maybe I could just also, frame this in the following way, since this is a historical panel. We've had this big shift in central bank openness from a period of minimal communication to sort of maximal communication. And Stan Fisher was saying on the previous panel that the sunlight rules about needing to release information about a meeting are such that he can't talk to his fellow governors, 5 of them, without everything being minuted. So he feels that's a constraint on efficacy. Maybe, Liaquat, you could start and put it, give us a sort of, we began from a period when people didn't communicate, right?
Well, that question was asking, I think, given the size of the balance sheet, if inflation started ticking up to 4%, would the Fed have the courage to raise interest rates sharply? And frankly, I think they would. I think the view that inflation, when it gets out of hand, is now well entrenched. I don't think we're going to go to try and experiment a la 1960s. So I think they could there. On communication, look, I think this forward guidance stuff is, if you don't know what you're going to do, how can you communicate what you don't know? So I think there's a fundamental problem. It sort of works in models, but it doesn't work in practice. And so I think we've exaggerated the efficacy of forward guidance. But that's, I think, a separate question to the one that was.
Yeah, well, first of all, central banks can live comfortably with any size balance sheet relative to GDP. Right? They have the instruments. If all else fails, if your monitors to say, when in doubt, sterilize. If the banks get a mojo back when they start lending again. If that doesn't work, raise reserve requirements, turn excess reserves into required reserves. If you don't like that, because it's not nice to the banks, raise the remuneration rate of excess reserves, right? You can, I think there's absolutely no problem there. The Swiss National Bank has 83% of GDP balance sheet. It makes the Fed look like Scrooge. And on the communication, I think there's far too much of it, right? That is not the same as accountability, right? But communication in advance, right? This avalanche of increasingly incomprehensible written and verbal statements from the Fed and other central banks is, and then this communication by committee, which is impossible. You can deliberate by committee, make decisions by committee. That can work. There are some problems there as well, but that can work. But communication by committee, no. At most one person should talk, and preferably nobody. Right? So the Fed has really gotten into a mode that they are talking without knowing what they're talking about. They're confusing the daylights out of the market. And I don't think that's good. Accountability is very important. Ex post, there has to be accountability. And especially in times of crisis, you want to know ex post with a due lag of time to allow for confidentiality and commercial sensitivity, blah, blah, blah. What the Fed bought or the central bank bought, from whom and on what terms. right? Because there's a lot of problems in this country before that was finally acknowledged by the Fed, and it wasn't its proudest moment when it took a threat of a lawsuit to make that possible. So I think accountability, yes, but ex ante communicating, no. When in doubt, say nothing.
Mark, yes, so the academic fraternity has evinced some enthusiasm for open communications, forward
Well,
guidance, and
let me go back. I first want to second a point that Willem made about the balance sheet. I mean, one thing we should have learned from the experience of Japan, the US, the UK, and the Euro area, there is no connection between the inflation rate and the size of the balance sheet. Look at the data. In fact, I'm constantly dumbfounded that people keep talking about inflation exploding when you see no connection. And the reason is this stuff, these liabilities, this is stuff you can pay interest on. There's tools you can use to avoid inflation and have an exit and drawing down.
It's a sovereign
the
wealth
deficit.
fund.
Yeah. So yeah, and it's a hedge fund. Essentially, what happened in the crisis is the private hedge funds tanked. The Fed went into the hedge fund business to kind of prop up the flow of credit. So the balance sheet, I think that's maybe one of the least of Janet Yellen's problems now, if I dare say. On communication, I mean, I'm sympathetic to what my fellow panelists are saying, but with one important caveat. We're at the zero lower bound. So the only game in town for manipulating interest rates is through communication and somehow giving the markets a sense of which way rates are going on, so the markets will price rates in a way that will be consistent with the Fed's accommodation goals. Now, unfortunately, that's not an easy thing to do, and there are many people that want to weigh in, and that makes it more complicated. But I think given we're at the zero lower bound, we can't abandon communication.
but this presumably is a game you can't play too many times. I mean, in the early 2000s, when the US was worried about repeating Japanese-style deflation, this was the first time when forward guidance became fashionable at the Fed, and there was I think, talk about it then. Because you were were not at the zero lower bound, but you were approaching it. So then it kind of has this moment in the sun, it goes away a bit, it comes back with a vengeance after the crisis because you are at the lower bound. But surely people have by now figured out that the Fed goes yada, 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 yada when it can't act and cut because it's at the lower bound.
But it's also not right what you say, right? I mean, even if you're not at zero lower bound, the next rate decision means nothing, right? It's only the future course of rates, right? That matters.
Yes,
and
but
that's
the
true at the lower bound or away from the lower bound.
But the fact that you're not...
You have to say something about what
in
you're
that
gonna
case,
do.
you want to get markets to get some sense of your reaction function. But to just blab, right, and then have to reverse yourself and to unblab, right? You remember these thresholds? What was it? The 6.5% and the 2.5%, right? No sooner were they announced than the unemployment rate went right through them, and oops, they went. Same happened to Carney, right?
Mark Carney.
Yeah.
But what they're struggling with is the following. You have a weak economy, you're worried about a lost decade, and the worst thing that can happen now is if rates preemptively rise because the market thinks they're going to rise, you start pricing this in, you have high interest rates, that slows the economy. So the trick is, how do you deal with that? What's the right way to accumulate the path of accommodation you like in a world where there's lots of uncertainty?
Another question. Yes, right here.
Of Pace University. Vice Chair Stan Fisher mentioned that the New York Fed has a very complex map of the various relationships among the various players. My question is, does anybody understand that? And can anybody explain the various feedback effects, both adverse and non-adverse, that can happen in the system? The best example being in 1987, when an initial shock in the stock market was amplified because of portfolio hedging. There are such adverse feedback loops, obviously, in the system. Does anybody understand them? Thank you.
Who wants to take a crack at that? Stan was saying that the New York Fed has created this map of interrelationships in the system. I don't know whether you have heard that from colleagues of the Fed or...
It's a laudable enterprise, and
but will it be a successful one?
I hope it's complete.
Yeah.
I mean, we didn't understand it well enough before the crisis, that's for sure. Because AIG wasn't on the map.
That's what they should be doing, but
Yeah,
it
that's
is
what they
really
should be doing.
chasing, the blind man chasing a black cat in a dark room, and the cat isn't there.
So this is a highly encouraging one can but try
But
answer.
I think that, under Dodd-Frank and so on, the goal is to move in that direction, to, have the Fed more directly engaged and.
I saw another question back here in the middle there.
George Wiesner, Credit Suisse. Looking back, I haven't heard discussion of maybe Glass-Steagall erosion was part of the problem in separating the too-big-to-fail deposit insurance institutions from those who want to play roulette in the capital markets. What does the panel think of looking back at reestablishing a Glass-Steagall separation? Simple, not as complicated as Volcker.
Take a crack.
I mean, my view is that the crisis occurred in investment banks which had no commercial banking activity.
Yeah.
There were other commercial banks that went under, that were heavily involved in real estate, but that had no investment banking activity.
Yeah.
So I'm not sure that the sort of coalescence of investment banking and commercial banking was a source of the problem.
In the UK, again, the first victim of the war was Northern Rock, which was pure mortgage and mortgage-backed securities and housing loans.
That's right. I agree. I mean, I see what we've learned is the problem is dealing with highly leveraged, systemically relevant financial institutions,
Whatever they are.
complicated by the fact that often we can't see the leverage exposure.
Especially with through derivatives, you really have to crawl inside the minds of the traders almost before you know what's done.
For those who believe that Glass-Steagall ought to be brought back, I think the most convincing contention is that bringing multiple product lines into one institution creates a managerial challenge that means it's more likely that you'll have people making, banks themselves will make mistakes because they're trying to keep their tabs on too many different activities and it becomes too complex. And
My local grocer can sell apples and potatoes, so I really don't think that is obvious. You have to judge that one case. There are these economies of
the
scope.
question was more about your local employer, but
Yeah, but I think one way to solve it would be do away with deposit insurance, right? You don't really need it, except sort of a de minimis amount to protect granny, right? If you have a lender of last resort, you don't need belt and braces.
question here.
Jason Tepperman, Promontory Local Credit. A question for the panel in terms of bank regulation and the impact of the Basel rules on macroprudential policy. There's an argument that part of, or one of the sources of the last crisis was the ability of banks to take assets with high risk weights, securitize them, and then hold them on their balance sheet with a much lower risk weight. The new regulations we have in Basel III are much more complex than the old ones. Does the panel think that this is additive or negative for financial stability? And what might be done going forward?
Anyone want to make a guess about whether Basel III is better?
I mean, I have to say I've been skeptical about risk weights just because that sort of preempts, that, if you like, prejudges the problem. So, and it's particularly a problem in Europe where government bonds continue, I think, to be low risk weighted when we know that's one of the principal risks. So I've never believed in risk weighting as an effective mechanism.
If you're going to have risk weighting, you definitely should attach the risk weights to, and for the matter, concentration, exposure limits to sovereign debt as well as to commercial debt. But I agree that you basically haven't got a clue what they should be, and if they have to be left to the banks themselves, right? That is like asking a bank how much capital you want to hold, right? The answer is always rather less. And so I don't think it's very meaningful. And I think you have to move away from that. And Basel Well, I don't understand Basel, right? I've tried to
Yeah.
understand it, but I find it completely incomprehensible. So we find out with the next crisis whether it has improved things.
Yeah, I mean, I don't think anybody can pretend that they have the answer to what the optimal risk rates or capital ratios are. But again, I'd go back to this idea to making sure that the application is sufficiently broad across financial institutions, because what happened, the old Basel was tightened and in response to the banking crisis of the 80s and the 90s. The problem was a lot of this stuff was not only securitized and held on balance sheet, but then it was sold. So the bank got the profits from the origination, and then you had these investments banks holding the stuff, and they proved to be vulnerable. So at least you want to make sure that you broaden the regulatory oversight sufficiently.
So I'm going to give the last question to Byron Wien, and everyone can take a crack at it, and we'll wrap up.
Liquat, in your book, Lords of Finance, you established the fact that those bankers were facing a similarly complex situation. And there was quite a variability of understanding of the situation and what to do with it. And one of the reasons they didn't act effectively is because of disagreements among themselves. Now, if you were going to write a similar Lords of Finance book, let's say 10 years from now, looking back at the pre-2007 period, I would think that those people had less of an understanding of what was happening to them than the people in the 1920s. Is that a fair assessment?
Well, I mean, we didn't get a Great Depression, so that's a fact. So they did some things much better than the previous group of people. The financial crisis portion of this financial crisis was multiples what happened in the Great Depression. Yeah. But you know, in 1929, if you took bank assets, it was about 50% of GDP. If you took bank assets and shadow bank assets in the US, it was 150% of GDP in 2007. In Switzerland, it was 600% of GDP. In Britain, it was 450% of GDP. So we're dealing with a gigantically different animal now. And I think we all agree that neither economists nor central bankers fully understand the way the financial system interacts with the real economy and what makes it so, what are the trigger points that make it so unstable. But they did do a better job than 29.
Willem, final thought?
I would also say they did, anticipation and prevention, complete rubbish, right? So probably as bad as anything in 29. But in terms of dealing with the financial crisis, preventing it from destroying the financial system completely, I thought they were very effective. And also then, in terms of just the monetary policy, the expansionary monetary policy to get out of the Great Recession to the extent that was possible without active fiscal support, I think they did as well as could be expected, except, of course, in Bundesbankia, right? That's the 20s still. Yeah.
I'll just end with the following thought. I think we've forgotten one of the great coincidences of history, that the person who happened to be at the helm of the Federal Reserve was, at the time, before the crisis, was the world's leading expert on the Great Depression. And I firmly believe that's an important reason we didn't have another one.
Mm-hmm. Amen.
So the next session will begin in 15 minutes at 3:45 with a panel made up of former central bank leaders. But I want to thank Liaquet, Willem, and Mark.
They had one.